Hello everyone, I hope you are doing fine. In this video, let us just conclude and learn about the accounting treatment of the pooling of interest methods and in the nature of merger. Basically, in the case of the nature of merger, the very first method for the accounting is the pooling of the interest method. Okay, let us just continue and learn about it. Let me give me the heading accounting treatment. So basically, number first is the pooling of interest methods. Okay. Under this, the assets and liabilities along with reserves of the transferor company. So what is a transferor company? Who is transferring? Who is transferring its assets to the another company, and that another company will be considered as a transferee company. Are recorded at their existing book value. At their existing book value. No goodwill or capital reserve arises. There will be no case of the goodwill or the capital reserve. Any difference between the consideration paid and the share capital of the transferor company is adjusted against the reserves. Okay. So in the pooling of interest methods, the assets and liabilities with reserves of the transferor company are recorded at their existing book values. No goodwill or the capital reserve is there, but the difference between the consideration paid and the share capital of transfer company is adjusted against the reserves. Okay, we'll understand that how. For example, let me consider an example here. Here, there are three companies. Company A, Company B, and Company C. Okay, these have to amalgamate. Three companies are amalgamating under pooling of interest methods. Under pooling of interest methods. Here, it is given that for the company A, assets amount to rupees 5 lakhs. Liabilities amounts to rupees 2 lakhs, and the equity is rupees 3 lakhs. For the company D, For the company B, assets, liabilities, and equity. Assets, liabilities, and equity are as follows. Company B have the assets of rupees 3 lakhs. Company B have the liabilities of rupees 1 lakh. And company C have the equity of rupees 3 lakhs. Then comes the company C. Sorry, let us just consider only two companies. Company A, company B, and then company A plus B combined balance sheet. Company A and company B combined balance sheet. Assets. Let us just make it this way. Particulars, but before combined balance sheet of company A and company B. Here, particulars, company A company B combined. Okay. So, assets, liabilities, and equity. The assets of company A amounts to rupees 5 lakhs. However, the assets of company B amounts to rupees 3 lakhs. The combined assets will be 5 lakhs plus 3 lakhs, that is rupees 8 lakhs. Now, same for liabilities. Liabilities for company A is rupees 2 lakhs. Liabilities for company B is rupees 1 lakh. Hence, the total liabilities will be 3 lakhs, 2 lakh plus 1 lakh. Now, for the case of equity. Company A has the equity of rupees 3 lakhs. Company B has the equity of rupees 3 lakhs. Sorry, company B has the equity of rupees 2 lakhs. Making it a total of rupees 5. And this is how the amalgamated balance sheet of a company will look like. Now here, no goodwill or capital reserve is created. And all the assets and liabilities are recorded at the book values. Okay. This is under pooling of interest methods. For the amalgamation in the nature of merger. Then we'll talk about the second method, that is the amalgamation in the nature of purchase. Amalgamation in the nature of purchase. Here, it has some certain conditions as well. And that is, any amalgamation that does not satisfy all the conditions of a merger is considered as a purchase. If all the conditions of the merger is not satisfied, that means it is a purchase. One company acquired the other company. Okay. For that, the accounting treatment will be as follows. Then we'll talk about the accounting treatment. Here we will follow the purchase method. So under this method, the transferee company records the identifiable assets and liabilities of that transferor company. Of the transferor company. These values are recorded these values are recorded at their fair value on the acquisition date. Okay. And any difference between the purchase consideration and the net assets acquired is recognized as goodwill or capital reserve. Okay. Then let us consider an example. Example. A company X acquires company Y. The fair value and the book value of company Y assets and liabilities are as follows. First of all, fair value. Assets are rupees 4,50,000. Liabilities are rupees 1,50,000. Net assets are rupees 3 lakhs. Also, the purchase consideration is given as 3,50,000. So we will first calculate the goodwill. We will now calculate the goodwill. Here, the purchase consideration is given as rupees 3,50,000. Is given as rupees 3,50,000. Net assets are rupees 3 lakhs. From the question, according to question, the net assets are rupees 3 lakhs, meaning that the remaining amount is what? Goodwill. That is 15,000. Okay. Now we'll make the accounting treatment. Accounting entries for the purchase method. These for the purchase method. Here, number one entry will be to record the acquisition. To record acquisition. Assets account debit. To liabilities account. To purchase consideration account. This will be rupees 4,50,000. Liabilities will be rupees 1,50,000. And the purchase consideration will be rupees 3,50,000. Sorry, 50,000 is just make an contra entry in here only. Goodwill account debit. Now, why we have done this entry in here, I'll tell you. Here, The assets were 4,50,000. Okay. Liabilities were 1,50,000. The purchase consideration was 3,50,000. That means there was a misbalancing of the accounts. So if the balancing is on the debit side, it will be balanced off with the goodwill. That is the 50,000. And if it is on the credit side, it will be balanced by the capital reserve. So it is there was a deficit on the balance side, on the debit side. Hence, we raised it as the goodwill account debit, rupees 50,000. Okay. In next class, we'll talk about the purchase consideration. I hope this much is clear to you. Thank you, guys. Thank you so much.